Welcome back to A Dollar Wealthier, where we teach you all about how to manage your money wisely and leverage what you know and have to become financially abundant. Here in today's video, we'll show you how to start investing. But if you're new to investing, it can be intimidating to get started. But don't worry, we're here to help. In this video, we'll cover everything you need to know about smart investing, from setting financial goals and creating a plan to achieve them, to understanding the risks and returns of different investments, and adjusting your portfolio as needed. We'll also discuss common mistakes that new investors make and provide tips for seeking professional help and finding resources to support you on your investing journey. But before we continue, don't forget to like and subscribe to our channel to stay in the loop. So, let's get started. Smart investing refers to the practice of making informed and strategic decisions about where to put your money in order to achieve your financial goals. Now, first things first, why is investing important, especially for beginners? There are a few key reasons. First, investing can help you grow your wealth over time. By putting your money into investments that have the potential to earn a return, you can potentially earn more money than if you just kept your cash in a savings account. This can be especially important if you're saving for long-term financial goals like retirement or buying a home. Second, inflation is the natural increase in the price of goods and services over time, which means that your money will be worth less in the future if you don't take steps to protect against it. One way to do this is by investing in assets that are likely to increase in value over time, such as stocks or real estate. By investing in a variety of assets, you can spread out the risk of any one investment performing poorly. This can help you weather market ups and downs and protect your wealth over the long term. Defining your financial goals and creating a plan to achieve them. Before you start investing, it's important to have a clear understanding of your financial goals. What are you saving for? Is it retirement? A down payment on a house? Your child's education? Or something else? Having a specific goal in mind will help you determine the best investments for you and give you a target to work towards. Once you have your goals defined, the next step is to create a plan to achieve them. This should include a budget to help you save and invest the money you need, as well as a timeline for reaching your goals. For example, if you're saving for retirement, you'll need to consider how much you need to save each month, how long you'll have until retirement, and what type of investments will best help you reach your goal. Next up is diversifying your portfolio to manage risk. Diversifying your portfolio is an important part of managing risk in investing. This means investing in a variety of different assets, such as stocks, bonds, real estate, and cash, rather than putting all of your money in just one type of investment. There are a few different ways you can diversify your portfolio. One is by investing in different asset classes, such as stocks, bonds, and cash. Each asset has its own set of risks and returns. And by investing in a mix of them, you can spread out the risk of any one asset performing poorly. Another way to diversify is by investing in different sectors, such as technology, healthcare, and finance. This can help you spread out the risk of any one sector performing poorly. Now, let's talk about understanding the relationship between risk and return in investing. As you start investing, it's important to understand the relationship between risk and return. In general, investments with higher potential returns also come with higher levels of risk. For example, stocks have the potential to earn higher returns over the long term, but they also come with risks of losing money in the short term. On the other hand, investments like savings accounts and certificates of deposit tend to have lower returns, but also have lower levels of risk. It's important to find the right balance between risk and return for your individual financial situation. If you have a long time horizon and are saving for a long-term goal, you may be able to take on more risk in your portfolio. But if you're closer to retirement or have shorter-term goals, you may want to focus on lower risk investments. Smart investing also involves researching potential investments and staying up to date on market trends. Once you have a good understanding of your financial goals and risk tolerance, it's time to start researching potential investments. This can include stocks, mutual funds, exchange-traded funds, and much more. As you research potential investments, It's important to consider the fees associated with each one. Some investments come with high management fees, which can eat into your returns over time. It's also a good idea to read reviews and do your own research on the investment to get a sense of its performance and potential risks. It's also important to stay up to date on market trends and news that could impact your investments. This can help you make informed decisions about when to buy and sell and help you avoid potential pitfalls. Another important factor is monitoring and adjusting your investments over time. Once you've made your investments, it's important to monitor and adjust them as needed to make sure they're still on track to help you reach your financial goals. This can include rebalancing your portfolio to make sure you're still diversified and aligned with your risk tolerance, as well as reviewing your investments periodically to ensure they're still performing well. It's also a good idea to have a plan in place for how you'll handle market downturns. While it can be tempting to sell off investments when the market is down, it's important to remember that investing is a long-term game. In many cases, it's better to hold on to your investments and ride out the storm, rather than selling and potentially missing out on future gains. It's also crucial to seek professional help and find resources as a new investor. If you're new to investing, it's understandable to feel a little overwhelmed. That's why it can be helpful to seek out professional help or find resources to support you on your investing journey. One option is to work with a financial advisor or investment professional who can help you create a customized investment plan and provide guidance on your portfolio. You can also find online resources and courses to help you learn more about investing, such as blogs, podcasts, and our YouTube channel. Now, let's discuss some common mistakes to avoid when starting out investing. As a beginner, it's natural to make a few mistakes when you start out investing. Here are a few common mistakes to avoid. Not having a clear financial plan. As we mentioned earlier, it's important to define your financial goals and create a plan to achieve them before you start investing. Without a plan, it's hard to know what investments are right for you and how to allocate your money. Chasing after high returns. While it can be tempting to try to earn the highest possible returns, it's important to remember that higher returns often come with higher levels of risk. Be wary of investments that seem too good to be true. They may come with hidden risks or be scams. Not diversifying your portfolio. As we mentioned earlier, diversification is key to managing risk in your portfolio. Make sure you're investing in a variety of different asset classes and sectors to spread out the risk. Failing to stay up to date on market trends. It's important to periodically review your investments and stay up to date on market trends and news that could impact your portfolio. This can help you make informed decisions and avoid potential pitfalls. Not being patient. Investing is a long-term game, and it's important to be patient and stay the course. Don't get swayed by short-term market fluctuations. Stay focused on your long-term financial goals. While investing can be intimidating, the long-term benefits of patience and discipline can be well worth it. By setting clear financial goals, creating a plan to achieve them, and investing in a diversified portfolio, you can potentially grow your wealth over time and protect against inflation. By taking a long-term approach to investing, rather than trying to chase short-term gains, you can set yourself up for more consistent, stable returns. Additionally, by sticking to a disciplined approach, you can avoid making impulsive decisions that may not align with your financial goals. Patience and discipline can also help you ride out market fluctuations and not panic when facing short-term setbacks. In the end, the discipline and patience you practice today can pay off significantly in the long run, helping you achieve your financial goals and build a more secure financial future. Thank you for watching this video. We hope you found this video helpful and that you feel more confident in your ability to start building your investment portfolio. Remember to set clear financial goals, create a plan to achieve them, and diversify your portfolio to manage risk. And don't be afraid to seek out professional help or find resources to support you on your investing journey. Thanks for watching. If you found this video helpful, be sure to give it a thumbs up and hit the subscribe button to stay up to date with all our latest investment tips and tricks. And don't forget to share with your friends and followers. The more the merrier. Good luck and happy investing.